Hello and welcome to the Maple-Brown Abbott 2026 Outlook Series. My name's Dean McLelland and with me today I have Dougal Maple-Brown, Head of Australian Value Equities at Maple-Brown Abbott. Welcome, Dougal.
Thanks, Dean.
So value equities enjoyed a comeback in the back half of 2025. What do you think drove that, and do you think it will continue into 2026?
Yeah, thanks, Dean. Even with hindsight, it's not easy to say why things changed, and in some cases changed quite violently. I've said many times before that valuation is like an elastic band. It can stretch and stretch and stretch, often much further than you think is possible, and then it just snaps. And some of the valuations were crazy. Let's take CBA, the biggest stock in our market. At the peak, it was trading at over 30 times forward earnings in the middle of the year. This is for a stock, a bank, which consensus had minimal earnings growth for. Now, CBA, along with many of the growthy and techie names, have come back quite materially. Relative to market, CBA now is down about 20% over the last few months. But my forward-looking point, and again using CBA as an example, is that the stock still looks expensive to us at about 25 times forward earnings. And by the way, it's not just CBA. Wesfarmers, another top 10 stock, owners of the Bunnings hardware chain, that stock peaked on almost 40 times forward earnings. Again, it's come back a wee bit. Today, it's probably on the low 30 times. But again, for a stock which is forecast to grow earnings at a modest clip, low single digits, it still looks pretty expensive to us. And then finally, just to give a flavour of how far market darlings can fall, I'll use the example of CSL, a stock we now own, by the way. In COVID, so roughly 5 years ago, CSL was the biggest stock in our market and traded at almost 50 times forward earnings. Absolutely mad. Now today, after that stock has halved, even more against the market, the stock trades on a high teens multiple, 17 or 18 times. And by the way, that stock is forecast to grow earnings at high single digits.
And apart from valuations, what else do you see impacting markets in 2026?
I think the other key thing to think about is interest rates. And following some fairly high inflation prints, at least in this country, the Aussie curve is no longer factoring any further cuts, and indeed some economists are now forecasting rate rises. So the people who are relying on rate cuts to drive the Aussie equity market are probably going to be disappointed. People who are relying on a further PE re-rating driven by rate cuts will definitely be disappointed. And this is in stark contrast to other markets around the world. For example, in the US, where the Fed are cutting, maybe not quite as fast as the president wants, that market may get some support from rate cuts, but that won't be the case in Australia.
And can you summarise your outlook for 2026 for us, please?
Given the high starting point of high valuations in many parts of the market and the probable lack of rate cuts, our view is that returns are going to be pretty modest. Overlay that with the fact that Australian earnings for the market as a whole have now gone backwards for 3 years now, but the market's gone up. Frankly, that leaves us a little nervous. The upside is that our portfolio contains none of those expensive growth and tech names, so we should be well positioned as valuations continue to normalise.
Thanks for your insights today, Dougal. I wish you and the team all the very best for the year ahead.
Thanks, Dean.
If you'd like to hear more about Maple-Brown Abbott's Australian value equities, please visit our website.